Are you over 70 and wondering if it's too late to invest? Well, here's the truth. It's not too late. In fact, it might be one of the most powerful times to invest wisely, strategically, and with purpose. You see, just because you're in your 70s or beyond doesn't mean your money should stop working for you. Whether you're retired, semi-retired, or just getting started with investing, you still have options. And more importantly, you still have time. In this video, we'll break down why longevity makes investing after 70 more important than ever. Smart, lower-risk strategies tailored for your stage of life. How to protect your money from inflation without gambling it. And the mindset shift that turns fear into financial freedom. This isn't about Wall Street hype or risky plays. This is about preserving what you've built, earning steady income, and maybe even leaving a legacy. But before we dive in, tell us in the comments, what's your biggest question or fear about investing after 70? Are you worried it's too risky, not worth the effort? Or are you already investing and want to share your experience? Drop your thoughts below. We're building a community where age is not a barrier and every dollar has purpose. Now let's get into it because your financial story isn't over yet. It's just getting smarter. Number 1. Age is just a number, especially in investing. Contrary to popular belief, turning 70 does not mean you should stop investing. In fact, age should not be the primary factor in deciding whether or not to manage or grow your wealth. What matters most is your financial goals, risk tolerance, time horizon, and personal circumstances. Many people in their 70s today are living active, engaged, and financially dynamic lives. With life expectancy steadily increasing, it's not uncommon to live well into your 90s or beyond. This means you could still have 20 to 30 years of financial needs ahead of you. Retirement is not a finish line, it's a new financial phase. You may have already saved and invested for decades, but the strategy doesn't end there. Inflation, healthcare costs, and unexpected life events can all impact your retirement funds. Continuing to invest can help your money keep pace with the cost of living and potentially leave a legacy for your heirs or a cause you care about. Even after 70, investing is not only possible, it's often necessary. The goal shifts from aggressive growth to smart preservation and strategic income generation. But with a thoughtful approach, your investments can continue working for you well into your later years. Number 2, rethinking the risk. It's not about avoiding it, it's about managing it. The common myth is that once you hit your 70s, you should move everything into ultra-safe assets like cash or bonds. But this all-or-nothing mentality can be dangerous. While it's true that you may want to avoid high-risk volatile investments, eliminating risk entirely can expose you to another major threat: inflation erosion. The key is risk management, not risk avoidance. At this age, you can shift to a more conservative portfolio that still includes a mix of asset classes, such as dividend-paying stocks, bond ladders, real estate investment trusts, REITs, and even annuities, if structured correctly. These investments can provide income, preserve capital, and offer some growth to outpace inflation. It's important to diversify your investment strategy so that no single event like a market downturn or rising interest rate destroys your financial footing. A mix of investments reduces volatility and cushions the impact of market swings. Also, consider your own personal risk tolerance. Not every 70-year-old investor is the same. Some are financially independent with pensions or real estate income, while others rely entirely on their retirement accounts. Your personal situation should guide how much risk you can take in at your age alone. Number 3, income generation. Your new investment focus. When you were younger, you probably focused on growing your portfolio. In your 70s, that focus may naturally shift toward generating consistent, reliable income. This is where income-oriented investment vehicles come into play. These include dividend-paying stocks. Blue-chip companies with a long history of paying and increasing dividends can provide steady income. Municipal bonds, often tax-free at the federal level and sometimes at the state level, muni bonds can be an excellent low-risk income source. REITs. Real estate investment trusts can provide high dividend yields and exposure to real estate without the hassle of property management. Bond ladders. This strategy involves purchasing bonds that mature at staggered intervals, giving you regular payouts and reducing interest rate risk. Annuities. Fixed or income annuities can provide guaranteed income for life, though fees and terms should be carefully reviewed. The objective is to build a portfolio that produces enough income to support your lifestyle without needing to constantly sell off principal. This approach can also help you preserve capital, reduce tax liabilities, and plan more confidently for long-term expenses like healthcare and travel. Number 4. Tax strategies. Smarter moves after 70. Once you hit age 70 and a half, and especially after turning 73 under the Secure 2 Act, the IRS requires you to start taking required minimum distributions, RMDs, from your traditional IRA and 401k accounts. These distributions are taxable and can bump you into a higher tax bracket if not managed properly. So how can you invest smartly in your 70s while managing taxes? Qualified charitable distributions, QCDs. You can donate up to $100 per year from your IRA directly to a qualified charity. This satisfies your RMD and reduces your taxable income. Roth conversions. If you anticipate being in a higher tax bracket later in retirement, converting some traditional IRA funds into a Roth IRA can lock in lower taxes now and allow your money to grow tax-free. Tax loss harvesting. If you still have a taxable brokerage account, you can offset capital gains with losses. Municipal bonds and tax-free investments. Income from certain investments can be tax-exempt, helping you keep more of what you earn. Being strategic about taxes can preserve more of your portfolio's value and improve cash flow. It's also wise to work with a financial advisor or CPA who understands retirement tax planning to help you navigate the nuances. Number 5. Healthcare costs. The hidden threat to your wealth. One of the most unpredictable expenses in retirement is healthcare. Studies show that a 70-year-old couple could need over $300 to cover medical expenses throughout retirement, not including long-term care. Investing wisely can help protect you from this financial burden. Here are ways to safeguard against medical costs. Long-term care insurance. If you're in good health, consider getting this to cover future nursing home or in-home care needs. Health savings accounts, HSAs. If you had one earlier, you can still use it tax-free to pay for qualified medical expenses. Investing for liquidity. Keep part of your portfolio in assets that are easily accessible for medical emergencies. Annuities or dedicated healthcare funds. Some annuities are designed to provide increased payouts for long-term care expenses. By factoring healthcare into your investment strategy, you can reduce the likelihood of being forced to liquidate assets at an inopportune time like during a market downturn to pay for care. Number 6. Leaving a legacy. Investing beyond your lifetime. Many people in their 70s begin to think more seriously about their legacy, not just financially, but in values and impact. Smart investing can help you leave more behind for loved ones or charitable causes that matter to you. Roth IRAs. These are excellent legacy tools, as heirs can receive tax-free distributions under many circumstances. Trusts and estate planning. Consider working with an estate attorney to set up living trusts, charitable remainder trusts, or donor-advised funds to direct your assets according to your wishes. 529 plans for grandchildren. If education is important to you, helping fund a grandchild's college can be a powerful way to invest your money meaningfully. Gifting appreciated assets. Instead of giving cash, you can gift stocks or property, which can carry tax advantages for both you and your heirs. Legacy investing is not just about money. It's about ensuring that your wealth continues to reflect your values even after you're gone. By managing your investments strategically, you can create lasting benefits for generations. Number 7. Embracing lifelong learning and financial adaptability. The financial world is always evolving. New regulations, market conditions, and investment vehicles emerge constantly. The willingness to adapt and learn is one of the most powerful assets you can possess at any age, especially in your 70s. Here are a few practical steps. Stay informed. Read financial news, watch investment updates, or subscribe to newsletters tailored to retirement investing. Consult professionals. A certified financial planner can help you optimize your portfolio for your goals, while a tax advisor ensures efficiency. Use tech tools. There are apps designed to help retirees track expenses, forecast retirement income, and analyze investments. Rebalance regularly. Even a conservative portfolio can drift over time. Rebalancing helps maintain your ideal asset allocation. Adapt goals as life changes. Perhaps you initially planned to downsize but now want to age in place. Your investment strategy should flex with your evolving lifestyle. Above all, remain open. Lifelong learning keeps your mind sharp and your financial decisions informed. It's never too late to gain new skills, insights, or strategies, especially when it comes to managing your money wisely. Closing thought. Investing after 70 is not just possible, it can be powerful. It's about protecting your dignity, providing for your future, supporting your loved ones, and staying in control of your financial destiny. With the right mindset, tools, and guidance, your 70s can be one of the most empowering financial chapters of your life. If this video brought you value, don't forget to like, subscribe, and share your thoughts in the comments. Are you over 70 and still investing? Or are you helping a parent or loved one manage their retirement portfolio? Let us know below. We read every comment. Thanks for watching, and we'll see you in the next one.